Hello folks, and welcome to Pro Trader Strategies Market Commentary for Wednesday, March the 24th. I'm Eric Wilkinson, and some of you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how those come in to impact the markets with some of my market analysis. I'm going to do the same thing for you folks in these daily market commentaries, but I'm also going to be talking about option strategies I implement into my portfolio based on those assumptions I come up with in my economic, geopolitical, and market analysis. So without further ado, let's get on with the economic data, see how that's impacted the markets, and get on with what I've been doing in the overall trading category. All right, so across the pond, we got Great Britain's consumer price index coming in slightly lower than expected, which is surprising with the price of crude oil that we've been seeing lately. But anyway, it came in at 0.4%, expected to be 0.8%, and PPI input coming in at 0.6%, PPI output coming in at 0.6%. The output is a little bit higher than expected. The input was in line with expectations, so it looks like they haven't been able to pass on those higher prices on the inputs to the producer, and now it looks like they are passing that on to the consumer. What does that mean? That means we are going to start seeing some inflation there. As prices start to rise, that is inflationary, and if the producer can pass that on to the consumer, they are absolutely going to do so. All right, so now flash estimates for the PMI. This is the most important data point for European region. It is a precursor to the final, which is going to come out in about a week, but this is always usually, or this is the one we really want to look at or keep an eye on. Now keep in mind, the manufacturing sectors of Europe is France and Germany, so let's get on with it. We got the French flash services PMI coming in at 47.8, expected to be 45.5. They did revise last month's number up to from 43.6, remember, was a really dismal number, to 45.6. Now, with these economic data points, one thing to note with the PMI, Purchasing Managers Index numbers, anything above 50 is expansion, anything below 50 is contraction. Obviously, that French services manufacturing or services PMI, French services PMI coming in at a below 50 number there. All right, then we got the French manufacturing PMI for the flash estimates coming in at 58.8, expected to be 56.4, higher than expected and above 50 expansion there. Good to see. 66.6 for the German flash manufacturing PMI, knocking it out of the park, expected to be 60.4. So really a good reading there. And then the services sector for Germany's PMI coming in just slightly above 50 at 50.8, expected to be 46.4. So seeing that service sector really move above 50 for the first time in quite some time, at least pre-pandemic. As a matter of fact, it is the first time we've seen a positive number since July of 2020. And then before that, it was basically going back all the way to pre-pandemic February 2020 as well. So finally starting to see that number really creep back above 50. Good to see there. And then the broader European region coming in with the manufacturing PMI coming in at 62.4, expected to be 57.4. Better than expected there, obviously, and above 50. Services sector, though, waned a little bit, below 50, coming in at 48.8, expected to be 46.1. Again, still below pre-pandemic levels there. All right, moving back over here to the United States, we got our own economic data, and it was quite a bit of economic data, to say the least. We got the core durable goods orders coming in at negative 0.9, expected to be a positive 0.6. Not good to see there. Durable goods, that was core durable goods orders, and keep in mind that excludes transportation. But when you add back in transportation, we got a negative 1.1, expected to be a negative 0.7, so worse than expected there. Our flash manufacturing PMI number coming in lower than expected at 59, still above 50, which is expansion. And then the services PMI for the United States coming in at 60, right in line with expectations there. We also got our crude oil inventories finally at 1.9 million barrel build, expected to be a 1.4 million barrel build, higher than expected. Build would make us believe that there would be some downward pressure here in crude oil. Well, we can see that crude oil is absolutely not moving off of the the highs there. We're starting to retrace back into the 60s. We got into that 50 handle yesterday. Remember, I thought that the next stop was then going to be 54. Well, nice big reversal today on a crude oil inventory build. Counterintuitive? Maybe. Well, let's dig into these details. We saw a distillate drawdown. That means there's demand from the manufacturing sector and demand for crude oil. Gasoline. So both of those are aspects of this number that we don't always readily see. And that is really going to be the driving force, I believe, today, is that demand for the refined products of crude oil. All right, so we can see crude oil, like we talked about, up over $2.50 on the day. We've got the bonds. After yesterday's big move to the upside, I was expecting us to start breaking this pattern of lower highs, lower lows. It hasn't broken that pattern yet. As a matter of fact, we've only taken a bounce off of this Fibonacci and now coming up with a newer lower high, all right, if we were to confirm that and start retracing again. So not out of the woods on higher interest rates at this point for the bonds. A couple of Fed governors coming out and kind of saying we might actually go a little bit higher at the end of the year, whereas we heard Powell talking not until 2023. Some of these other Fed governors are starting to clamor that they could see interest rates rise a little bit sooner than later. Gold futures up $4.50 on the day, while Bitcoin is up $1,300 on the day, making a bit of bottom here. I would expect Bitcoin to start moving to the upside here. Gold, it's a bit of a head scratcher there, as we're seeing the dollar strengthen. That should cause gold to come off a little bit. There's nothing wrong with that, to be quite honest, but I would expect that these alternatives to currency, fiat currency, would do well at the same time, and we're not necessarily seeing that here with the price of Bitcoin versus the price of gold. Gold coming off, probably more due to the strength in that dollar. It's one of the highest readings we've gotten in the US dollar since the pandemic. All right, again, here we have the Dow Jones Industrial Average up 300 points on the day, almost erasing all of yesterday's losses. Today, NASDAQ up 20 points. You know, it was the leader to the upside for the better part of the day. It did finish slightly in negative territory as weakness started filtering into at the end of the day and across basically all commodities. Tech sector was struggling more so than anything else, but and we're struggling again today. I think Intel was one of the few stocks in that tech sector that was in positive territory earlier on today. And now we're starting to see some other ones start to move to the upside, even some of the blue chip tech stocks that I'll talk about here in a moment. But we can see E-mini S&Ps up 25 points on the day, and overnight inventory was long. You can see that late day sell-off did go up there and test yesterday's value area high shortly thereafter our daily market commentary, but then you can see the weakness just filtering into the markets all the way into the day. I talked about this. It looked like I was expecting us to see more of a downward pressure testing the value area lows of yesterday. That's what happened. Overnight, pretty flat. Coming into today, maybe a little bit long. We jumped to the upside on those economic data points, and now starting to get a little bit toppy, it feels like. Maybe a little bit of a retracement going to happen here, but as at this point, it feels like an inside day, despite the fact that it's not. It's just slightly outside of the parameters for that, but it does feel very inside day-ish, and I would expect the risk is to the downside, as it feels like people are looking to take risk off the table right now, especially with the tech sector seeing some weakness here and money going into the blue chips, that we've been continuing to see this sector rotation in a sense. I think we're going to continue to see that, especially throughout the rest of 2021. I think that after we see these big parabolic moves in the overall equities markets, we have a basic year of consolidation as the market kind of works through this inventory, and we'll see some moves to the upside, the downside. One of the big things is, how are these taxes going to come through from the Biden administration? We're hearing that basically capital gains taxes could be increased to almost 40+%. What is that going to do to the overall equities? I would expect that a lot of people are going to flush out of their entire positions in the overall portfolios that they have. because keep in mind, anything that they have as a mark to market, wherever they bought it, they would cash out, get out of that position heading into the new year, and then reestablish those positions at higher levels. And then they pay a lower capital gains tax on the stocks that they owned and had owned from probably very attractive levels, and they were worried about taking capital gains. Well, this would be the catalyst to cause people to take capital gains taxes off, because they're saving themselves 20%, right? If you got a capital gains tax just slightly over 20% and you increase it to 40, well, it's going to save you 20% in taxes. People will absolutely do that. That would cause the overall equity markets probably to crater as those people cover those positions, wait to the beginning of the new year, reestablish a long position or whatever position they had, and then they would been taxed from that point forward from that initiation. So we could really see that cause the markets to be in massive turmoil if we start to see something like that coming down the pipe. All right. Last thing we got to talk about here is my IBM trade. Now, obviously, yesterday I did this IBM trade on this candle here. It was looking pretty bearish, like a toppy area. And I always talk about this. We want to, with a covered call strategy, sell the rips and buy the dips. Well, that's exactly what I did, was sell some rip in this and got into the covered calls again in the April. Now, if you guys remember, my covered calls right here, the 130 covered calls expired worthless. The market thankfully settled just below that 130 handle, which allowed those short calls to expire worthless. I'm still long the overall stock, so we got a couple of moves to the upside. Yesterday, I decided to do some more covered calls in here. Volatility didn't really go up, but that's not necessarily what I'm looking for, just lowering overall cost basis. Earnings cycle is in the next month, so I'm able to get a clean month on this, and sold the April 136 calls in there for 61 cents. Now, obviously, I could do it a little bit better today. I think it was trading around 80 with that move to the upside, but I'm usually early on these trades for that type of move. We're up at those levels where I say that that's probably the level I would be willing, or that is the level I would be obviously willing to sell this out at, is above 136. That is a great strike location. As you can see, we haven't breached that in the last year. I don't think that we're going to see that again before their earnings as well. So those covered calls I'm pretty happy with. Now, based on a swing type trade, I added on a negative delta trade. With this being said, thinking it was more of a swing type trade, making a topping pattern, didn't really wait for it to get confirmed. So I'm always a little bit early on that aspect as well. And I went into the April, bought the 130 puts, and then sold the 125 puts in there for that long put spread. I paid a debit of 150 on that. Obviously, it's not working out very well today because the directionality is against me here, but I was playing this for a swing type trade. I'm going to let this play out a little bit longer here. We maybe break above this Fibonacci here. That would be something that would make me cover that long put spread. I'm going to leave on the covered calls because I reestablish this position after the earnings if it gets called away from me. So I'm going to leave on the covered calls, lower that overall cost basis. This directional trade is something completely separate from this position. So don't get that too confused that I'm layering positions on with the same underlying. I'm playing this because of a directional swing type trade. The covered call strategy is obviously a longer duration type of strategy. So those are the only two trades that I put on, and I put those on yesterday towards the end of the day, right before our webinar that we did, and that, or actually I did a guest spot yesterday on the March Market Madness series. So check that out. You'll get tape sent to you. It was a pretty fun one. I went right after a really good speaker. So what I was doing followed along with that. So that's nice as well. So all of those things working out nicely. Take a moment to go over our disclaimer. As we're an educational company, I'm not here to get you guys to do what I'm doing. I'm just trying to teach you guys how we implement options into our portfolio based on finite mechanical structure. So that streamlines your process to find that optimal option strategy for you. All right, that's all I got. Hope you guys all have a great one. And if you can't pick that, take it easy.